At Option Genius, we believe that you deserve freedom, financial freedom, so that you have no more worries and more than enough money. Time freedom, so that you could do what you want, when you want to do it. And choice freedom, to live your life on your terms. But the system and Wall Street are rigged against us little guys. So how do we fight back? Well, my friend, that's what this podcast is all about. My name is Alan Sama, and this is the Option Genius Podcast. Welcome, Genius Nation, to another edition of the Option Genius Podcast. This is going to be a special edition because not only am I here by myself, but today I am joined by Jeff Stanton, and it's going to be our first ever interview podcast. So in the past, all the other episodes that we've done, I've basically been talking to the mic, and I've been talking about whatever topic interests me, and we go on and try to help and try to share my knowledge. But this time, I've actually been lucky enough to get Jeff on the phone and going to be asking him some questions. Jeff is a professional trader who lives out in New Jersey right now. And so how you doing, Jeff?
I'm doing fine.
Awesome. Cool. So let's get down to it. Let's get started. So how was it that you got started in trading?
It's a long, interesting story, but basically when I was a kid, I took a summer school class when I was like 10, 12 years old that had to do with markets and learning about businesses, and we sold stock and ran a business and actually made a bunch of money as a summer school class. And at that point, as a 12-year-old, I thought, making money off of the stock market seemed like a really great idea. My parents were arguing all about stocks all the time. And so literally on the morning of my 18th birthday, I took all my savings, opened up a brokerage account so my parents could not interfere. A broker laid out 10 different stocks. I picked one, and over the course of about 4 years, I made 400% on my first trade. And I spent a lot of hours in college trying to figure out the markets, as in charts or as in balance sheets or what, technical analysis or monkeys throwing darts at a Wall Street Journal or whatever. And I really fell in love with technical trading and charts. And this was back before computers, and I did everything by hand. And over the years, I got married in college, and unfortunately I had a wife that wanted to spend 120% of whatever we earned, so there wasn't much in the way of investment funds. I then got divorced in my early 30s, and I was able to put some trading stakes together. And I was a full-time employee in the computer programming billing area for phones and cell phones most of my life. And I did very well in the late 90s with the internet bubble. I was able to hold on to a lot of that money, and I was able to save a lot of money. And I have a new wife that is very like-minded, which turned out being very great. And so I've tried different things: futures, options, stocks, mutual funds, all different types of systems, with varying degrees of success, and trying to do that while working full time. And I accumulated a nice stake of money. And then finally, my job decided they did not need me anymore.
Oh,
man. So I lost my job last December and decided to do this full time, which it just seemed like the stars kind of aligned properly with finances and my knowledge, I think, and the fact that my other half provides me with health insurance, which is a good thing. And so I find myself here today spending about 6 to 8, 9 hours a day in front of a bunch of screens trading.
Okay. So you've been doing this then about a year, almost a year now, professionally, like full-time.
Doing it full-time. My previous job allowed me to do a lot of trading because a lot of my clients were international, and so I was working all hours of the day. So that freed up a lot of mornings for me. So I was probably for about the last 5 years been very, very active.
Okay. And what do you trade, or what have you had the most success with?
Okay, so that's another thing that I believe in if you're trading options or if you're trading stocks or futures, whatever, you need to do things in a way that allows you need to diversify, in my beliefs. You need to do things in a way that reduces stress as best as possible. And so actually I have my money kind of divided up into multiple buckets. I have a bucket for fixed income. I have a bucket for mutual funds. I have a bucket for dividend stocks. I have a bucket for options. And then I also have a bucket for an S&P mechanical system that I also trade. My main trading, as in my short-term trading that I'm really doing every day, is really in the options field.
Mm-hmm.
So the majority of my trades are in options. Most of the other stuff, is multiple weeks, multiple months, sometimes years.
Right. And so, what percentage do you put in each bucket?
It's different. So like the fixed income, I think, has about 10, 12%. The mutual fund has probably about 35%. The S&P system has probably about 25%. The dividend stocks have about 10%, and the options about 15%. Off the top of my head, I hope that adds up to 100%.
It's close to it. I didn't do the math, but it's really close to it. Okay, yeah. Cool.
But each has, and so what I hope to, because I still feel like I'm learning a lot about options. And so a lot of the other stuff is fairly automatic. I want to increase my option trading. I want to increase my goals in options. I want to learn more about options. And like right now, it's been a very frustrating year for in my opinion, of the options trading with the low IBR and the low volatility. And so it's been very frustrating that I've been, in my options account, I seem like I've been bouncing around between up 0 and up 8% back and forth. And I've had about a 5% drawdown over the last month. Mm-hmm. But also, too, as I feel like, I'm still in the learning stage, and I'm spending a lot of time trying to educate myself the best I can. And I've done some bonehead rookie mistakes of defending trades way too quickly. So, mm-hmm. and with the options trading, I'm trying to push myself that, during higher volatility times, I hope to have about 40 positions on 40 different underlyings. And right now I'm actually sitting on, I think this morning I'm at about 17 or 18 right now. So it's been frustrating with the way that I trade.
Right.
So.
Right. Yeah. I mean, that's like very different from the way I do it, because for me, I would like not to be that active as you are. Obviously, you said earlier that you're trading about 6-7 hours a day. My main focus is I want to be doing as few trades as possible while hitting my monthly goal. And so the volatility in the iron condors, the credit spreads, or something like that I do, it's not as big of an issue. And we came across you in our Facebook group, which is called the Option Traders Alliance on Facebook. And, I asked you, because you were posting your trades graciously, and you posted, you put at least 1 or 2 trades every single day. And I asked you, I'm like, wow, how many trades do you do? And you responded with about 30. And I was like, wow, knowing myself, I lose focus if I have more than maybe 10 to 15 trades on at a time. If I get up to that many trades, like 15 trades, I start finding out that, hey, I'm missing stuff, and stuff happens, and I start screwing up, and I start taking losses when I don't have to. It's really interesting that you have that many on, and that you're frustrated that you don't have enough trades on.
Yeah. So, some of my philosophy with this is that, I think that, one of the things that any option trader has to do is that they have to have reduced commissions. I mean, you can't be paying ticket prices or really paying more than $1 or $1.50 contract.
Mm-hmm.
And with paying a small amount, that allows you a lot of flexibility with all the different strategies. And so instead of concentrating on a couple of stocks, I try concentrating all over the place, or I try spreading it out all over the place. I try my best to be diversified also in the options trading, that I try having currency trades on, bond trades on, gold trades on, oil trades on, and different industries and stocks, so that you have it all spread out. I keep my number of my contracts down very, very small, because I just believe that, you should be constantly trading, constantly harvesting gains. And, I've mentioned on the website, that, on the Facebook, that, I'm kind of a hasty trade philosopher type of trade, which, they have the idea of trade small and trade often. I believe also too is that you get better at trading the more decisions you make. And, I think that, my basic goal is to, in a given year, have 1,000 trades during the course of the year. And, it comes out to being about 3 a day. Mm-hmm. And you've seen my trades going up on Facebook.
Right. Right.
But it's been very hard with the low implied volatility. And right. I've not had too much luck with debit and credit spreads. So I don't do a lot on them. I typically stick. A lot of my trades are just strangles. So.
Right. Yeah. The one thing about tasty trade is that, like, I know they say that, trade small, trade often, but they're pretty much a broker now. And I mean, they were a broker before when they were tied to Ameritrade. Now they're tied to the new one, Tasty Works, I think it is. So, I mean, I kind of feel like, okay, would they really be doing that or not? But I totally agree with you that the more you trade, the more experience you get. And so somebody who's trading, 1,000 trades in a year is going to learn 10 times faster than somebody who's doing, 100 trades a year. So that I definitely agree with you there. Backtesting, I think, would also be a huge benefit to somebody who's just trying out, because that's a lot of times that's how I started. Well, I didn't get started that way, but I learned much faster that way by getting myself a good backtesting software and then just doing it over and over and over again through multiple different time frames. Because what I see is that, you've been trading in 2017 where we have a very low volatility environment and the market has just been, kind of melting up slowly. And so people who get started at this time frame, they might master it and they get really good at it. But then when the volatility comes back, they're going to get shocked. That's one thing that you really have to be careful of. So what was sorry, go ahead.
I was just going to say that, like, last year when we had higher volatility, it felt more like, shooting fish in a barrel. It was a lot easier to trade with the volatility and not a one-sided market. But go ahead with your question.
Okay, so then my next question was, so what was your biggest aha in trading? Like, when was it that the light bulb went off or something clicked and started working out for you? Because obviously, you've been doing different types of trading for a long time, and I know that you were kind of the decision was made for you in a way that you were laid off, but there had to be that confidence that you had that said, you know what, I'm gonna go do this on my own. What was that for you?
Well, yeah, it's just kind of like funny with, the thought that comes to mind was simply, okay, I have this opportunity to try this full time and I'm going to take this opportunity, and, the worst thing that happens is I have to go get a job,
right,
basically.
Right.
And so, I said that, there's a lot of ideas that, that I picked up from Tasty Trade, but I also just from, all my experiences with all the other groups that I have come across over all these years. So, I have my own method of madness as in how I trade and all this type of stuff. But I just, I really believe from the standpoint that I started, it's funny, I just like thinking about all this is that, when I first started trading options, I was basically, writing cover calls. And then, I stumbled across the idea of, okay, there's these stocks that I would like to buy cheaper. And so I would just put in naked puts, and I'm going like, okay, lo and behold, you get the stock at a cheaper price, or you pull up, you get the premium.
Mm-hmm.
Then I noticed when I was doing that a couple of times, something crazy in the market would happen, some volatility, and the premium would get a lot higher. And so suddenly I was, waiting for like sell-offs or something like that to do this, and I noticed I could get more premium. Then I stumbled across it, just like I got kind of screwed up on a trade by earnings, and because I thought, okay, this is rich premium, and I didn't quite understand the concept of earnings and how that affected options.
Mm.
And so then I started selling, put options on earnings plays.
Mm-hmm.
And, the craziest thing with that was that I had put on 44 earnings trades. I had made money on 42 out of the 44, but yet I was down money because the two that went against me had 4 standard deviations going against me.
Yep.
And that was the moment I'm going like, if I'm going to do this at any type of regular basis, I need to get some training.
Uh-huh.
And so I started picking up anything that was free on the internet. And, like I said, I also came across Casey Trade and really went crazy with all their free type of stuff. But the aha moment, I guess, was that it seemed like selling premium one day just like dawned on me that it seemed like it was less riskier than owning stocks, that the probabilities seemed higher to make money than actually owning stocks, because it seemed like stocks were more of a 50-50 shot, and you could set up option strategies that you could pick your probabilities, and by properly managing the trades, you could generate a better success rate.
Exactly.
Also, too, that something I didn't understand is that options are typically overpriced because they can't properly price in the black swan event. And so, something might be out there with like a delta of, say, 16, so you have an 84% chance of it staying in the money. But statistically, if you really look at it, it's more like an 88%. And then if you put some simple rules around on how you're going to manage your trades that go good and bad, hopefully you make money.
Right. Yeah, no. I mean, definitely, I think, options are an awesome way to go about it. I think stocks do have should be in the portfolio. And for people who are just starting out, like you said, the story that you told, that you started with the covered calls and then you moved on to the naked puts. I think everybody can pretty much relate to that, because that's how everybody gets started originally. Because that's when you first get started, that's the only thing you're allowed to trade by the broker until you get more experience. So yeah, I mean, I have many stories about covered calls and then covered calls gone bad. But one of the things that we always tell everybody when they're new, especially, is that, hey, earnings, you should stay away from. Whether you're selling premium or anything, it's just there's too many unknowns out there that, yeah, you can win so many times in a row, but you miss that one time, even if the company knocks it out of the park, even if they have good earnings, sometimes that stock is just going to drop because the stock went up too much already, or some analyst came out against it, or whatever reason. So it's definitely something. So how do you go about finding your trades now?
So actually, to give you one story on the, whoops type of thing, that back in the 80s, I was trading commodities, and I was long the broad market, or the value line, for people who actually remember what that was, and I was short the Dow. And this spread would move, maybe $200 a day up or down and not have anything happen. Well, lo and behold, in Chicago, there was the Tylenol scare with Johnson & Johnson. Somebody had poisoned people using Tylenol pills, and Johnson & Johnson cratered on that. And in the course of 15 minutes, that spread moved $28,000 on me.
Wow.
And I was just lucky to be in that position where it was a $28,000 profit. But at that point, my account was only worth $30,000. So I could have been like wiped out. So, but getting back to your question about how I look for trades, I frankly believe that the best time frame of taking money out of the market with the options is to put a trade on where there's like 40 to 55 days before expiration, and with the idea that you would either roll or get out of the trade, say 20 days before expiration. That seems to give you the least amount of risk but the most decay in premium. And basically on a couple of different platforms, I have a bunch of lists of stocks broken down by industry that I will sort by either IB or IBR rankings to see which stocks have the most or the least amount of premium in it. And then based upon the stock chart patterns, I really like selling strangles when a stock is within the middle of a move, where if it's in a range, to try picking it within that middle of that range. Something that is a very, very important point, I think, for any option traders, especially new option traders. You must pick liquid stocks. You must pick liquid option contracts. And so I typically stay away that if the bid-ask spread on these option contracts on, say, the strangle that I want to put on is more than, say, 20 cents, I usually stay away. I mean, you can go into strangles on, Facebook and Apple and a bunch of these guys where they're penny wide.
Right.
Sometimes if I'm doing something in Amazon or Google or whatever, yeah, I'll break that rule because they're just good stocks to trade. But they try being liquid. I also, if a stock is like at a top of a range or at a bottom of a range, I might do, call or put ratios where, I buy one and sell two, kind of picking a top or picking a bottom. Or another way that I set up trades is like, a stock like Boeing. It just had been going to the moon. And so what I've been doing is I'll sell a call spread and finance it with a put. And so that, if the stock continues to go up, I will collect enough premium that I will not lose money on the call spread that I sold if the stock goes beyond the call spread, but that I only have downside risk. And with Boeing, it's worked out pretty well for me on something like that.
So you would sell the call spread on Boeing?
Yeah, I'll sell the call spread,
right,
and I'll sell a put. So if the call spread is like 2.5 points in Boeing, I will try selling the call spread and the put that I would like collect like $3.
Okay.
So that if Boeing keeps on going up, I make 50 cents. If I get lucky with Boeing and Boeing goes sideways for a couple of weeks, I might be able to pull like $1 out of it.
Right. Okay.
So, it's
yeah, because you mentioned that your risk was only on the downside. So I was like, wait a minute, if you're selling a call spread and it keeps going up, then your risk is on both sides. But okay, I see what you're saying. You're trying to get more credit in the spread.
Yeah. And if you go and somebody coined the phrase, they refer to those as J lizards. Why? I have no idea why the name is called that. I had never even heard it up until like about 6 months ago.
Okay.
And also too is I will do earnings plays. I don't do many, and probably actually my worst losses this year have been on a couple of earnings plays. But so I'll keep an eye out for that. I've also been clipped on the fact that you put on a trade and you roll it, for whatever reason it hasn't met your profit target, and so you just roll it to the next month, and unfortunately then that month has the earnings in it, and so I've had a lot of fun with that a couple of times too. But,
okay. All right. So if I heard you correctly, what you said is basically you look first for, maybe you do a scan or you do use some kind of screener that'll show you which stocks right now or which options have the highest IV or implied volatility, so that you get more premium than normal, right? And then
that's correct.
You go ahead and you put those in a list, and then you take a look at each of those charts, and then you see, what can you play with it, and then you take this, then you say, okay, this is what this is doing. I can play it as a strangle if it's going sideways. If it's moving in one direction, then you can do the J lizard, either up or down, and then based on that, okay. So that's cool. That's interesting.
And I have these lists set up, and I probably go through the lists like twice a day. And you have special situations where, maybe Donald Trump tweet about some company, and suddenly it'll pop, the volatility will pop up on it, or there'll be rumors of a merger, or they'll pre-announce, or, and anything that'll suddenly increase the volatility. And the one thing I haven't mentioned is that I definitely do not believe in holding on to the position until expiration. I always have, depending upon the trade type and how I feel about the stock, I'll typically have, for a lot of the strangles, I'll try taking 50% of the premium out. If I'm doing like a straddle or a J lizard or a ratio, I'm looking for like 25%. And, sometimes that also too, if I have a profit goal of like 50%, but for whatever reason, recently right after Facebook had its earnings, I put on a trade on Facebook, and its premium just collapsed over a couple of day period of time. And I took a 25% gain in 3 days. So if I can take a real fast profit, I'm taking the money and getting out of there. I'm not going to hang around for my 50%.
Okay. Do you have a dollar goal on each trade? Like how much you want to make in dollar terms?
Not necessarily. Last year when the volatility was much higher, I was always trying to put on trades that had $2 worth of premium at least, and trying to collect a buck out of it. But there's been so many trades this year that, I just recently put on a iron condor on GM that I only collected, I think, 88 cents. And, I might take 30 or 35 or 40 cents out of something like that. But also too, on the other side, sometimes with a strangle, I will put on something on Facebook, Netflix or Apple that is a little farther down. I might go 60 days out and put on something that has $5 worth of premium, with my goal of only taking $1 out of that, just, allowing the premium to collapse a little bit, where, the strangle will be a little tighter and you're looking to, quickly get the profits out there. Mm-hmm. But if we had normal volatility, I would love to pull $1 out of each trade that I make, but that's just not possible this year.
Yeah, I mean, we haven't had normal volatility in a while. I mean, for the way I was doing it, even last year was pretty low volatility. But the cool thing about options is, like, I'm listening to you, and I was like, you trade in one way, I trade in a totally different way. And it's cool that options are so versatile, and so, there's so many different ways to do it. There's so many different people doing it in their own way with their own styles that you can accommodate everybody. It's so cool. I mean,
yeah. I mean, from just that statement that you just made there, you look on the Facebook group, and there's a handful of people who are posting some trades, and I mean it's the whole different realm. I mean all over the place, as in how people trade.
Mm-hmm.
So it's a real cool thing that you can really do.
Yep.
The one thing that I believe that you would probably preach this, in your website and everything like that. The thing that bothers me, that kind of drives me crazy with new traders, is that somebody will sell like a 10 delta call or put, and so they have in theory a 90% chance of winning, and so they have this mindset that, okay, I sold it for 10 cents. That means I can make $10. And so 9 times I'll make $10. And on the 10th time, I'll lose $10. And
or $9.
It just doesn't work that way. Yeah. It's just like, and options are typically pretty well precisely priced. And so if you have a 90% chance of winning, and you're going to win, say, $90 on 9 trades, that 10th trade is really priced in a way that you'll possibly lose $90.
Mm-hmm.
And so it's a kind of a zero-sum game with the weight. And so that's how you need to manage your trades and manage your winners.
Definitely.
And have some thought process about that. But, that seems to be a real misconception there that for new traders, that really drives me crazy.
Yeah, we get asked that all the time. It's like, hi, the math doesn't work on this. If you're, just like you said, and our answer is always the same thing. It's like, why would you let yourself go and lose that whole amount on that last trade? I mean, if you have the ability to sit there and watch it, if your child doesn't know how to swim and, they're going towards the edge of the pool, wouldn't you get up and stop your child and pull them back? No, you wouldn't just let them dive into the water and drown. No, I mean, that's the same thing with this concept. So, we always preach that you should have a max loss, and it should be somewhere close to what you can make. So if you're trying to make, like, let's say 10% on a trade, your max loss should not be more than, maybe 30%. So if you're down 30%, it's going to take you 3 trades to get that back. That's time to bail out, especially if you don't know any other way to do it. But so how do you have anything like that? Do you have some kind of max loss or adjustment? How do you know when the trade's going bad? How do you deal with it?
I can be stubborn about that, to put it in simple terms. It's funny. At the beginning of the year, I shorted the utilities ETF and started writing covered puts against it. And I have really never been up on the trade. Now the trade is 11 months long. I'm still down about 200 on it. And I think that last count, I've made 14 trades on it. So, with like earnings, a lot of times, I mean, sometimes you just get in a situation that, you can try minimizing your loss, but, you start calculating, or I calculate, as in, what's the average premium I could probably pull out of this position if everything worked okay per month, and how far am I down? And does it make sense based upon the chart and what type of loss I have if I should continue on? And so I don't have any set rules of where, if it's a 1 times loss, 2 times loss, 3 times loss. But I will manage trades for a considerable period of time if I need to, if it seems like I can get myself back to a much smaller loss, or, if I can scratch it.
Mm-hmm.
So
you just keep rolling it forward then.
Yeah. And that's, I mean, from the standpoint that you're allowed to do that, as in, from a standpoint of the undefined risk trades. Mm-hmm. The defined risk trades, like the credit spreads or the debit spreads, you really don't have an option of rolling those. And there's only so much you can do to defend a position, like with an iron condor. Many times with an iron condor, if it's going against you, you can turn it into an iron fly and, collect some more premium. And in a sense, you have a butterfly and you just hope that you hit the middle just perfectly. But with like a strangle, once one side gets tested or one side loses so much premium, I roll the untested side down. And then, if the stock continues to go against me, then I might roll the untested side to point where I have a straddle on. And then sometimes it's necessary to even do and to become inverted on the spread where, you're trying to make money that particular way. But, once you get to the point where when you go inverted and you're not collecting the amount of money of the inverted spread, then I kind of then question, is this good to continue in? So sometimes, I will collect $1 and my loss on the trade is $5, $6, $7. That doesn't happen often, thank God. But, I've had trades. I've posted a couple of trades, I believe, on the Facebook where, I had a trade go against me that I collected $1.25 and the trade went 800 against me, and I just kept on defending it. And, after like about 3 months, I took it off for a $75 profit.
Right.
So.
Yeah. I mean, as an individual trader, when you're managing your own money, it's such a relief to be able to do that, because it's like, you don't have to answer to anybody. Like a lot of times if it's a trade that I'm doing with one of the services that we run, I have to cut it off. I have to say, okay, I can't just keep this going for 6 months at a time. I just have to stop it and say, hey, you know what? This is a loss. I'm taking the loss. I'm just going to start over next month and we'll do it again. But yeah, I remember when I first got started, when I first was learning, I kept a tally of every single ticker symbol that I had traded. And at the end of the year, I would go in and I would say, okay, did I lose money or did I make money? And I still have this list with me. And it had had the number. So like for the year, how much was I up or how much was I down on each ticker? And then my thing was, I'm going to go back into the ones I lost and I'm going to go get that money back. I'm going to make them give me my money back. But eventually I realized that, maybe I should do the opposite. The ones that I'm doing really well on, maybe I should just focus on those and grow up and not worry about the losses, because it's like, I was giving them like emotions and feelings where they're trying to hurt me when it's not real true. They don't care. The tickers, they don't care. They're not even real. And so when I realized that, I was like, oh, okay. Yeah. You know what? There are some symbols that you can trade. At least, depending on the style that you have, for some styles, these tickers will work really well, and for other styles, they don't. So that was like, for me, that was a big aha moment when I realized that. But that was so basically, Jeff, now that you've been doing this for a while, you've learned a lot, you've taken your lumps, and, like you said, you've been putting on hundreds of these trades. What advice would you give to somebody who is looking to make the change, to go from, hey, I'm a part-time, I'm learning about this, to I want to go do it full-time, where I want to pay the bills doing this stuff? What advice would you give someone like that?
You need to do this in an environment that produces as less stress as possible, because this can, drive you crazy. You can't just run into the market and go, okay, I need to make $200 for a car payment type of thing. So, you have to have, I would not recommend anybody doing this with borrowed money, definitely. Mm-hmm. But, you've got to first, even, before you quit your job and all that type of stuff, you got to know the mechanics. You got to have a method on how you are going to go against this, how you're going to make this work. You've got, I'm personally, for me, paper trading doesn't do it, but I do know a lot of people that paper trading is extremely helpful. I also believe that, anything you do, if it's paper trading or if it's real trading or other things, you need to keep statistics on yourself. You Definitely. Need to figure out what works for you and what doesn't work for you. And, the best that you can do before you go on to this adventure is figure out what you are comfortable with. Like, maybe it's just staying with iron condors or defined risk trades. Maybe finding a small group of stocks that you're very, very happy with. It's also very, very helpful if you have a supportive spouse that, you have a spouse that, with this. I also, too, is that something that, one of the nice things is my wife works at home a lot. So I have that communication with her. But, there's times that she's at work and I'm just stuck in my man cave by myself. And so you have to deal with the idea that, you're just looking at a bunch of screens. You may be chatting with a bunch of people online and everything like that, but you are, it can be lonely,
Yes.
And also too is that there's a learning curve. I mean, when you're risking money, you're not going to walk on water the first, the second, or third time. It's going to take a while to figure this all out. And, I've had so many fits and starts, with this. It's, I could write a couple of books on it, but, also too is that, I truly believe that this may sound counterintuitive, but, to just, especially when it comes to options, maybe just pick a couple of cheap stocks, like if, some $5 to $10 stocks that has options on it. Try finding something with some IBR and volatility on it and just put trades on. And who cares if you make money or not? Just manage them, trying to figure out, see how it all works, how the prices change. A lot of, I'm surprised that, people, some new people have come across where, somebody, buys a call spread and the stock goes way beyond the call spread for them and they believe they should have a full winner on, but you still have intrinsic value in the options. And so it's not a full winner yet.
Right.
To just understand the mechanics and, I have many brokerage accounts. So, I have the Tasty Word. I have a Toss account. I have an Interactive Brokers one.
Mm-hmm.
Interactive Brokers is very difficult in my mind as into rolling options. It's not user friendly in my terms and all that type of stuff.
I agree.
Toss and Tasty Works are very, very easy. I've done some really stupid things on Interactive Brokers, as in, thinking I'm buying when I'm selling, or I'm in the wrong month, or that type of stuff, where it's much easier to trade on you need to find a platform that you're comfortable with.
Mm-hmm.
You need to also, as simple as this is that, I went out and spent some decent money on a nice chair, because I'm going to be sitting in this chair a lot. And so, you don't want to have back issues or anything like that. Something too is that, during the trading day, I don't stay 100% stuck to my terminals for 8 hours. I would go nuts. I take a lunch break. If I get stressed out, I go, there's a park a block away. I go take a 20-minute walk. Sometimes, I go upstairs into the kitchen and read the Wall Street Journal for a while, just to, just not to allow the stress to build up, because, a lot of things, also the other thing, with a lot of these trades, when you put on a strangle, 85% of the time, you will have the strangle show a negative profit and loss, within the first week or two.
Right. And a strangle, for anybody that doesn't know, is when you're selling a naked put and a naked call on the same stock at the same time.
Yeah. You just don't, seldom do you just put a position on and it starts immediately making money for you.
Right.
So, you have to deal with it. And, if you put on a strangle or you put on an iron condor or whatever, maybe within a few days, one side or the other will get tested. And so you have to not panic about it that, you sold something for $1 and suddenly it's moved 75 cents against you. You need to let the numbers play out. You need to let the chart play out. You need the trade to play out. You can't panic about it. That the majority of the positions I have on right now show negative profit and loss because I'm waiting for the trade to work out.
You're waiting for the data to kick
profits, in. Yeah. And the ones that have shown profits and everything like that, I've harvested the profits and I've put on new trades. And so option trading, you get to see a lot of red on your screen from time to time, and you just have to get used to it. Right. And another, a crazy thing too, to just expand my own knowledge with all this, sometimes I'll hear somebody come up with this crazy idea. I think, you made a couple of comments about it on the Facebook page. I put on a double calendar on T-bonds. And I've never put on a double calendar before. I have no idea even how visually to look at how the profits would work on that. So I put it on knowing, I could make $30 or lose $30 on this because they're not fast moving or anything like that. But I just wanted to watch and learn how these trade so that I just add another tool to my arsenal with it. Also to, something else that, if you are a new trader and you have a small account you don't want to do iron condors because they're too stifling or whatever, that you would prefer doing undefined risk. Well, you can put on a strangle or a straddle and you can buy cheap wings on it to reduce your buying power on it. In many cases, you can cut your buying power by 2/3. So you still have, in a sense, an undefined risk, but because you have the protection on either side, you can trade with a smaller account.
Right.
And you can also use that idea to do that in like an IRA.
Mm-hmm. Yeah, so that's just like it's like an iron condor, but it's just got really, really wide spreads, just between the strikes.
That's correct. Yeah.
So, if you look at it, you chop it one way, you chop it the other, you're still dealing with the same thing. So, yeah, you've given a lot of great tips, but the one thing that stood out to me, and you said it twice, and I don't hear that many other people talking about it, is that you should trade in a way where the stress level is very, very low, or as low as you can get to it. And I thought that was really wise to say that. And that was one of the reasons that we have a product that we just came out with this year called Trading Hacks. And that's the whole point of it. It's different ways that I use to reduce the stress level, and you've mentioned 3 or 4 of them already in your interview, but I'm not gonna go point them out. But there are, the way that I see a lot of people losing money, especially new traders and even experienced traders. It's not just the new ones, but if you're operating at a capacity that is above where you can handle it emotionally and mentally, you make mistakes and you mess up. If the stress level is too high, or if something is going on emotionally, even in your life, and you're just not centered, mistakes are made, because a lot of people think that, I'm going to go trade the markets. They think that they're actually fighting somebody else on the other side. They're fighting the screen, or they're fighting Wall Street, or they're fighting other traders. But in actuality, I think we're actually fighting ourselves. That's the ultimate. Like, if you can master yourself and you can stick to the game plan, you can stick to your trading plan, you should have more losses and more profits than losses. And that, to me, is the ultimate adventure, So that's kind of, it's great to say that, we're trading options and we're making money out of thin air and we're just clicking buttons, right? And we're making money, but it's more of a emotional challenge, I think. So that's cool. No,
very much so.
Yeah, you've given a lot of.
I totally agree. If you're not sleeping at night Yeah.
Yeah.
You're not going to do well. Yeah.
Right. Yeah.
And I've had a few. I've had a few of those moments. In my career. So with that.
Exactly. Yeah.
And yeah, it's funny because there was one other point that too is that options trading, in my opinion, with this is that you have a high success rate. I can look at my statistics right now, and I have about 85% winners this year, and because of the low IBR, that I'm just above water. I'm not having an exceptional year. If you have a lot of volatility and I'm making 85% winners, I would be thinking that I would be hitting it out of the ballpark. And so people have to have, reasonable expectations. So also too, with a new trader, what I would also say to a new trader is that you can do these systems and you can get the set up where you're winning 80-90% of the time, but that also doesn't guarantee you're going to make money, because you have a certain curve of you have winners and losers. And so at 85% on a given year, you could be having a really, really great year. 85%, you could have a marginal, or you could actually be losing money. It all depends upon your methods and how well you're timing and how well you have harvested the money that's coming out of the market. So, to have proper expectations too. I don't know what you tell people with your website and everything like that, but if you have $100,000 of risk capital available to you, I believe that you should be able to generate on an average year, say 30,000 in profits in trading. Some years you could make 150,000 out of that 100. Okay. Mm-hmm. And other years it'll be a real struggle. But right. you have to, it depends upon how much risk, how many trades you're going to put on, how much, I always forget. The Greeks always lose me, but theta, how much you're going to collect out of that. So and also too, the other thing too, with a new trader, is like, so we've had a great market in the stock market this year. And I know a lot of option traders that are struggling. Over the last 2 years, the market has done okay, has gone up a little bit. But I know a couple of options traders who have just hit it out of the ballpark. So you can't base your expectations on your account on what the Dow does. Mm-hmm. That the option profits are not correlated to how the general market is doing.
Right. Right.
And that's one of the things that makes that is interesting about the options market in my mind. Mm-hmm. So.
Yeah. I mean, even and then, like, even just not the stock versus options, just option strategy versus option strategy is different. Like, you mentioned, I think you said that you were, some of your trades, because of the volatility is not being there, you're struggling to get some good returns. But we have a service called the weekly trading system where, I think it's up to 20 trades now for the year, and it hasn't had a losing trade all year. And we've been hitting, 5% on each trade. And they're weekly trades, so they only last a couple of days long. But the fact that no losing trades in the whole year, that's, like, we've never had that before. And it's interesting. You can go from strategy to strategy and get different results based on what's going on in the markets. So I think that gives a good way for people to understand that, maybe you have to be able to adapt as well. So a few years ago, like, when I got started, I was in different groups and stuff where mostly everybody was condor traders, and then we had the whole recession, or the Great Recession, and the volatility went through the roof. And then after that, everything, all that stuff happened. And there were so many people that only knew how to do iron condors, and they only knew how to do it in one way. Like, they only knew how to adjust it in one way. And they all left. They all stopped because they couldn't adjust. They couldn't hack it. They couldn't change it. So one of the things definitely when you learn with options is that there's always another way to play the game, and you have to be willing to make that change. So cool. So is there anything else you want to share with us, Jeff?
I did take notes, but it looks like I've captured a lot of what I was thinking that I was going to say. But if anybody wants to get a hold of me or anything like that, point them to the Facebook page.
Okay.
And, they can connect with me there and ask, I'm willing to, as my wife says, that there's times that I just don't shut up. I'm willing to talk,
right. No, it's
anybody about this and teach them.
I mean, like you said, it gets kind of lonely, especially with, probably 99% of the population has no clue what we do. And when you talk about options, they kind of get scared. And then when you talk about selling options, you lose everybody else. Even the people that are kind of interested, because they're like, what? What's a strike? What's a call? What's going on? The one of the basic questions I get is, how do you sell something if you don't own it? You got to buy it first, right? And then you sell it. Like, no, it doesn't work that way. So so it's called the Option Traders Alliance, and it's a private Facebook group, but it's free for anybody on Facebook. You just have to go and apply, and we'll let you in. That's not a big deal. And Jeff is in there, and he's posting every day. He's very, very generous with his time, and he posts his trades in there as well. So if you want to see what a J lizard looks like, or what kind of stuff strangles Jeff is putting on, you can contact Jeff in the group. I do appreciate you, Jeff. I appreciate your time. I appreciate you sharing your wisdom with us. And like I said, normally how I sign off is always trade with the odds in your favor. Want to know how to choose the perfect option trade for every trading situation? It's easy. Just download our free trading map and it'll tell you. Just go to optiongenius.com/map.